I'm Rick Plum with this week's Lucia Capital Group Weekly video. Throughout your working years, you earn your paycheck, and that paycheck is subject to various forms of taxation. Federal taxes, state taxes, FICA, Medicare, and maybe a few others. And the higher your paycheck, the greater the taxes you have to pay. At least that's the idea. So if that's the case, it would stand to reason that once you retire and those paychecks stop, those taxes will go down. Makes sense, right? Well, maybe not. Here are a few ways that a retiree can be taxed, which could catch you off guard if you're not prepared. First, and maybe most noticeably, you'll pay taxes on your retirement account distributions. Maybe you've been stocking money away for many years and you were able to take that earned income right off the top, deferring those income taxes to a later date. Well, at some point, that later date will arrive, either at age 72 with required minimum distributions or even earlier than that. Now, with any luck, your money has grown over time. But now every dollar you take out is subject to federal income taxes at ordinary income tax rates, which could be as high as 37% if you've got a lot. Now, secondly, your Social Security benefits may also wind up in the taxable column of your return. That's right, your Social Security benefits could be subject to ordinary income taxes depending on how much other income you have. So what constitutes other income? Well, those IRA and 401k withdrawals I talked about earlier, as well as rental income, dividends, capital gains, interest income, tax-free bond income, all of that counts towards what you've called your modified adjusted gross income, MAGI. And if you hit a certain threshold, you might see as much as 85% of your benefits subject to ordinary income taxation. Now, another tax that you'll see in retirement is for Medicare Part B. In 2022, most people on Medicare will pay about $170 per month for their Part B benefit. It's officially called a premium, but it's really kind of a tax. And if your adjusted gross income goes over $91,000 for a single person or over $182,000 for a married couple filing jointly, your Medicare premium goes up another $68 per month. And if your adjusted gross income is really high, like over $750,000 as a married couple, your premium could be as high as $578 per month per person. That's a big jump. Now, that's the bad news. The good news is that you may be able to avoid some or all of these taxes with some strategic planning by looking at today's brackets and your future projected brackets and trying to use them to your advantage. For example, if you can blend your cash flow from your IRA, Roth IRA, and personal accounts, you may be able to keep your overall taxable income down now by staying in lower income taxes or reducing the amount of Social Security that is subject to taxation without it blowing up in your face once required minimum distributions begin. Now, using the tax code, the standard deduction, the lower tax brackets and such, to your advantage should be the priority here. When it comes to Medicare Part B and D premiums, you can't always avoid those extra income-related monthly adjustment amount, IRMA surcharges, but for many retirees, they're often just temporary, sometimes the result of a large one-time capital gain. Now, the important takeaway here is that what seems like an unavoidable tax hit may actually be partially or entirely avoidable through strategic planning with a financial advisor. I've said many times that knowledge is power, and sometimes just knowing what the potential roadblocks are in advance may give you an advantage and allow you to keep more of your money. This is what we call tax management, and it's something we do for our clients every single day here at Lucia Capital Group. How can we help you? Just give us a call and let us know.